Despite being a popular choice among investors, REITs have taken a beating all year. So could three key changes in Singapore and from outside Singapore be a turning point for these assets? Investing in Singapore Real Estate Investment Trusts or S-REITs is one way retail investors can gain exposure to the property market without the hassle of owning physical properties. S-REITs are also a popular choice among income investors as they provide a steady source of dividends and offer one of the highest yields compared to some other asset classes. Recent up-and-coming developments could also make S-REITs a compelling investment case. First up, proposed new rules that will change how REITs are financed. Market watchers say the proposals are broadly positive for the sector.
The new proposed Monetary Authority of Singapore's leverage limit states that any REIT can have a maximum gearing of up to 50% with an interest cover ratio of 1.5 times.
The interest coverage ratio, or ICR, assesses how well a firm can repay the interest on its debt. A lower ratio signals that the company is burdened by debt expenses with less capital to spend. The aggregate leverage or gearing ratio looks at the ratio of a REIT's total debt to total assets. A lower gearing ratio means a company has more capacity to take on more debt, while a higher ratio could lead to credit concerns. Currently, REITs that intend to increase their gearing ratio from 45% to 50% must have a minimum ICR of 2.5 times.
So I think REITs managers have gone through GFC. They have seen, how important it is to manage the resilient balance sheet. So if you look at the average gearing, then it is about 38-39%. So the REIT managers, by and large, maintain a resilient balance sheet. Some REITs do fall closer to that threshold, and I think for them it will definitely be a lot more beneficial with these proposals. So names like Lendlease Global Commercial REIT, Suntec REIT, Keppel REIT, these are the names with relatively higher gearing. So these proposals will definitely come in handy to manage this phase.
SGX says that with a regulatory limit of 50%, this could mean over 20 billion Singapore dollars of potential debt headroom to fund expansion.
In case the interest requirements shoot up, so with a larger cushion they're able to sustain it better. That's, I think, the way the risk management is done. But with interest rates coming down, I think it's a policy measure that has been taken where the overall interest coverage ratio has been standardized across all REITs. Generally, again, my view is that most of the REITs are prudent and they will not go to that level of leverage taking by themselves.
The S-REIT sector is an interest rate sensitive one. And with interest rates set to head lower sooner rather than later, the sector could be turning a corner.
Interest rates has moved from 1% to 5.5% kind of level. It has impacted the REITs in two specific waves. One, financing cost is a big component of the REITs, and because the rates has moved up quite sharply, your financing cost has increased by some cases 50 to 100 points, and sometimes it is more than double of that also. That means you are getting lower distributable income, right? But good thing is that things are now coming close to a turning point, and what this means that whatever the pressures that could have been seen might reverse or slowly start to ease off. You might see that financing cost peaking at some point of time, possibly by the end of the year, and then easing. That means you will get more distributable income, more distributions.
Within the REIT space, analysts favor industrial, retail, and office REITs.
In the next 6 to 12 months, we believe that we still like industrial and the office sector. The reason why we like industrial sector is that the industrial sector has a very good fundamentals in terms of operational, especially the Singapore markets across many of the sectors except for business parks in specifically. Office sector, I think there has been generally a lot of pessimism towards this sector from and work from home. But what we do see is that things are changing. most of the people are at least back to office in 3 days, 4 days kind of thing.
We are still sticking with our preference of retail and industrial. On the office and hotel side, we are keeping a close eye on the office demand and the tourist arrivals. Tourist arrivals have been a bit soft in second quarter. So the best case for me right now is that retail sales will probably remain flat. The retail landlords will have to sacrifice some of the rental reversions, but overall it will be a steady story unless unemployment kind of rate spikes up for any reason.
When interest rates start to taper, S-REITs could offer a higher yield when compared to low-risk investments like bonds or even fixed deposits.
A lot of the REIT investors are actually yield investors. They seek yield. So therefore, if other safe instruments which provide yield, for example deposits, T-bills and all, then those rates that they offer come down, then hopefully these yield-seeking investors will move to a relatively higher yield of the REITs offer. I want to caveat there is no significant decline in the economic growth outlook. Then clearly I think the spreads you get becomes better, and therefore there will be more investors hopefully piling into the REIT sector, and then the yields will again compress. So the 6.2, previously I think in the low interest rate environment we were looking at 5.5%.
If you are looking at it from investing into a Singapore market at this point of time, we would say that somewhere between 30 to 40% of your Singapore portfolio should be focused on REITs in order to benefit from the long-term trends of real estate growth, real estate inflation. In addition, REITs also provides you with cash flows, semi-annual dividends, which can help you in a retirement kind of an instrument where you can have a consistent cash flows while benefiting from a long-term asset appreciation perspective, and maybe deploy some of your cash proceeds or some of your excess investments in bonds or fixed deposits into REITs.